most real estate is based on cap rates. So we know every dollar that we can add to NOI, what that does to drive value for our investors. I can't control what exit cap rates are. I can't control what interest rates are. I can control what's in between our four walls and a roof.
This podcast is for informational purposes only and does not constitute financial, legal, or investment advice. Please consult a professional advisor before making decisions based on what you hear on this show.
Welcome to that Wall Street Tribe. Excited to introduce to you Sam Morris. Sam, glad to have you on the show.
Yeah, man. Glad to be here, guys.
Sam, we're going to have a kind of a candid conversation about multifamily. So I'm kind of coming at you right out of the gate. What are the biggest myths right now you're hearing about why multifamily is risky or dead?
Wow. You know, it's kind of interesting that you would say that. You know, it's dead is really tough. I love it because, you know, one of the things about multifamily real estate, as opposed to really any other real estate, is that it's four walls and a roof. It's a necessity of life. As if food and water, you know, you got to have shelter. And so multifamily is not going away. So to say it's dead, I think would be quite a bit of an overstatement. But I always chuckle a little bit because everything goes in cycles, right? And it almost doesn't really matter what it is, but everything goes in cycles. And I was telling the guys the other day that this really does kind of feel like 2010 to me right now. And I know that's a while back, but you have to have been in the industry for a while to even understand what that means. But really what that means is, you know, after we got through, call it that 2008 financial crisis that crashed and did a lot of things to the market, right? It made it really scary to invest in multifamily. But the deals that we did during that time frame, we look back 2-3 years later after we did them, and we're like, oh my gosh, why didn't we buy everything at that time? You know, hindsight's 2020. And so to say that it's dead would be a wild overstatement. And I think you'd be potentially missing out on a massive opportunity if you were to say that. But to say that it definitely goes through cycles, for sure it does. And where we are within that cycle, I mean, I know what it kind of feels like from being in the industry this long, but it kind of feels like we're stricken back onto that upswing. And that's a great time to actually be investing into it. So a lot of reasons why people say don't do it is kind of the exact time of why you want to get back into it, because you're getting back at an appropriate time where, you know, the risks are accounted for, right? And the stuff that has gone through is actually accounted for in the deals. And you're getting into a deal that's a lot better risk adjusted than a lot of other opportunities that are out there.
How many summers do you have left with your kids? 10, maybe less?
And are you spending them together, or are you still stuck in the office while time slips by?
You want freedom. That's not the problem. The problem is you don't have a system that buys back your time. Without it, 3 years from now, your kids will be older and they won't care that your business was more successful. They'll remember you weren't there.
That's why we built the Passive Income Operating System, the plan we use to create over $50,000 a month in passive income. The system isn't free, but the training that shows you how it works is, and it's under an hour.
Go to wealthwithoutwallstreet.com/PIOS. Take the first step to buying back your time now.
What are the top 3 reasons that you're thinking we need to be aggressive right now pursuing multifamily? I mean, you mentioned a couple there, but what are those top 3 in your mind?
Yeah, I think a lot of the risk has pushed through the market, right? You're not seeing guys that are sitting there going, hey, you know, let's go ahead and do significant floating rate deals because, prices are going to stay low forever, right? You're also seeing a lot of the supply get chewed up. I mean, we had massive overbuilding, which creates a lot of that rental dynamics where you're not able to push rents and things or grow things the way so many guys pro forma it out. Well, now when you're starting to see things, in particular specific markets, not across the board, but specific markets where supply is being chewed into, well, you're starting to see record level renewals and actually rental increases because of that. And so there are a lot of reasons as to why. It's still going to be site specific and or sub-market specific. And that's why investing with somebody that actually knows what the heck they're doing and where they're at can be very helpful for those investors.
Well, I want to dig into that then. Tell me a little bit about kind of what deals are penciling right now. You talked about specifics, whether it's deal size, or is it the market type, or are you doing, value add like renovation type deals, or
What are some of those, current IRR yield targets? you have?
Sure.
Yeah.
Sure. I would tell you there's great real estate in a lot of areas, and great real estate never goes out of style. We've been best and final in several deals this year. And we've been made the bridesmaid on every single one because there are that many people that are out there looking for that good quality real estate. And so a lot of the institutional money, the bigger groups, they're coming in, and they're coming in fairly strong because of the value that they see at this point in time. So there's going to be levels where the real estate's been compressed to a level where it just makes sense to do, right? You're walking into a cash flowing situation, with good fixed rate debt. I mean, I kind of chuckle. You have to been around the block a few times to go, the interest rate market that we're in is actually pretty healthy. I mean, I wouldn't tell you it's good as it's ever been, because it hasn't, but it's not bad at all. I mean, it feels more normal if you've been in the industry for a couple decades. Like, this is actually a pretty good spot to be in. And the return metrics associated with that, have they compressed a little bit? Meaning, are you still seeing deals that are going to be turning 30, 40% a year? There's definitely some that are out there, but the risk that you're going to have to take to go get something like that could be tremendous, even in today's market. If you're seeing something that's solid, good real estate and good locations that you can make a decent return on, that's more attractive from a risk perspective to me, and to a lot of our investors.
Well, Sam, you are talking about there's multiple variables that make up the actual IRR, but let's hone in a little bit on the debt side, because that's been the thing that people got into so much trouble over the last 4 or 5 years, is that, like you mentioned it, floating debt instead of having good fixed debt. Talk about what you're seeing in terms of the options available and what you guys are maybe focused in on as you acquire these assets.
Sure. It's going to depend on what you're looking for from an exit strategy of the asset, right? And so, as unpopular as it may be to hear this right now, floating rate debt is still a viable option in this market for really any kind of real estate too. And that's the ex-banker me talking too, right? To be able to say something like that, that has not gone away. What you're seeing with a lot of guys too, and and this is across the board, not just multifamily, they're buying rate caps, right? Some of these guys are buying heavy in the money rate caps to synthetically fix their rate at a certain level where they can guarantee themselves some cash flow for a period of time. What you're effectively doing is you're prepaying your interest. The fixed rate option, depending on if you want to hold the deal for a certain period of time, absolutely can work. But if you have an exit strategy that's prior to what that fixed rate option is, the prepayment penalties, the defeasance, the yield maintenance associated with that can be highly detrimental to the returns. And so, I wouldn't throw out any kind of debt options. You have to just figure out what actually fits the model of what you're putting together. So if you go and say, standard deal for a lot of guys to go, hey, we're going to do a 5-year deal. We're going to try to get this kind of return, provide this kind of cash flow, and we're going to sell at the end of 5 years. That's great if everything works exactly the way you pro forma'd it, which there's no pro forma that's ever hit 100%. I mean, I've been doing this a while. I've never seen a pro forma perfect, right? It's either up or it's either above it or below it. That's just kind of the way it is. But debt is specific, and it actually can make or break a lot of deals. So a lot of the deals that have gotten in trouble in the last few years, it's because of the way they were financed, right? And so whether interest rates ran on, those operators, and they had a lot higher interest rate costs than what they were anticipating through their pro forma, or they're having to hold longer, and therefore the fixed rate options probably would have been better for them at that point, right? And so debt is absolutely something that comes into play. I would still tell you it's very readily available for multifamily assets, meaning there are a lot of people out there ready to lend on it, and it's actually gotten even more competitive. So the spreads in the debt world have actually compressed a little bit, meaning it's becoming cheaper even to borrow the money, not necessarily off of the indexes that we go off of. So much of what we do is either off the SOFR or the treasuries, but the spreads are coming in a little bit because there are more dollars ready to be lent in those markets.
This is spoken like a true banker out here, Stallion. This guy knows his debt world, right?
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
I do want to back up a little bit and double click into what you were talking about, certain markets, right, where supply is being eaten into. It seems like that the new construction stuff is not being built at the pace it was, whether that's interest rate, whether that's construction costs. Obviously, we got tariffs that may be, making people a little bit nervous on the steel prices. So which are the markets that you are seeing are still cash flowing? And what are some of the markets that you're avoiding as a result of that?
Sure. I can tell you, we invest almost exclusively in the state of Texas right now. Big state. And there are definitely, and we're pretty much in the primary markets. So think Houston, Dallas, San Antonio, Austin, right? And I can tell you there are world difference between those four cities, right? They're large cities, right? But I can tell you, which may be surprising to some people, Houston has been chewing through its supply faster than any other market that's out there. Right. And so it's actually recovering at a faster pace than a lot of other cities. Whereas if you looked at Austin was so overbuilt, so wildly overbuilt, it could still take 24 months plus before they really even catch up to a lot of their areas. But even within Austin, it's a different picture, because if you're in Austin proper, it's not as bad as if you were on the outskirts. And it's a people thing, and and how much supply you truly have. And so, if I were to rank it internally, I would say Houston's recovering faster than you're seeing rental rate increases there because it's recovering that quickly. Dallas is nipping on its heels, and the amount of people and in-migration into those areas is tremendous. They're some of the largest you're seeing in the entire country as far as the amount of people moving into those areas. And they're moving in because of really jobs. I mean, that's one of the things that we key in on is jobs, because as jobs go, that's where people follow, right? San Antonio's behind Dallas for sure. And Austin is still going to need quite a bit of time, right? And so if I would tell you just Texas, that's how I would look at it, right? If you look at some of the other markets, we've been looking at Phoenix a lot. I would equate Phoenix closer to Austin, right? It's just going to need time to chew through the amount of supply that came in. And so it is somewhat site specific and even sub-market specific within those markets. But as an overall, for some of these primary markets, Houston's recovering at a much faster pace than any of us anticipated. We're seeing record level renewals, record level rental growth from where we are as a country. But I mean, when I say that too, I'm not talking like 4, 5, 6, 7% rental increases. I'm talking, 1, 2. You're just, so the pro formas that you're seeing, if somebody's coming in and going, hey, we're going to have an 8% rental increase year one at this property, I'm not saying it can't happen. I would just want to see why it's going to happen in that specific submarket. Whereas if they came in and said, hey, 2, 3, and here's why, that may be more realistic when you're seeing these deals being presented.
So it sounds like you guys are really focused in on the demand of the area that you're looking at in terms of the amount of supply and how quickly those are getting taken down. And then the second thing you're talking about is, rent increases in those areas. Those are some specific things you're underwriting too. What are some other things that you're assuming or tightening down on to make sure that these deals are penciling the way that investors are looking for?
Yeah, so we've had some strategies over the last several years, right? So, you have a couple things that are outside your control operationally, really taxes and insurance, and they're two very large expenses for us. And then insurance, in particularly in Texas, has been something that we've been battling. And I can tell you, we've got great news because we have a big master policy. So we put all of our properties under one big master policy, and we get better pricing associated with that. Insurance, at least for us, has been tremendously better in the last 12 months or so. We actually just renewed our policy with a 30+% decrease this year. That's unheard of, right? And it's because of the way we operate the properties. That's in part of, more players coming into the market, things of that nature. Because as excess lines go and things like that, competitors would leave the market. Guess what? It's going to get more expensive. They don't want to take on the risk associated with it. But as you're doing things to limit your exposure, it can be real simple, right? Like we have hurricanes, things like that, right? It could be, all right, guys, as a matter of practice and what we'll show our insurance, we clean gutters out before a storm comes. You make sure drains are cleared. You make sure debris is gone. You could do a lot of things that actually can make an insurance provider go, yeah, you absolutely know what you're doing. You're going to be doing things that could limit potential loss. And we show that as an operator of how we do that, what we're doing, and that we have a process in place to do it. Taxes is the other big one, really big one, in particular for the state of Texas. And we've instituted over the last, call it 24 months, some tax abatement programs that we put together that will work with the local housing authorities, where we bring an affordability component to our sites. And because of that, we get an abatement of our taxes of a significant amount too. So it handles the question of what do we do for affordability, and it helps us from a tax perspective, which guarantees us more cash flow, guarantees us better returns associated with the property.
Sam, so those are obviously huge competitive advantages for you, that you're able to figure out ways to mitigate the two big expenses, taxes and insurance. What are some other advantages you think you have, your company, Lone Star Capital, has in specifically this market versus other firms? I'm an investor, right? I'm listening to you and I'm trying to evaluate if I'm going to put dollars to work, and I'm thinking multifamily is the space. Why basically Lone Star? Where are these, little bitty wins that's going to help me add those up to big wins over time?
Well, I mean, I would say those two things, one I just mentioned, are big wins. Those are real big wins. But the other aspect of it is we're still even though we have 5,000 units in Texas, we're still somewhat a small company, fairly nimble. Rob and I can talk, and in a matter of 30 minutes, policy can change, and we have the ability to speedboat, change directions, right? And because we're fully vertically integrated, meaning we have property management, asset management, construction management, all in-house, right? We're able to control all the costs associated with what we're doing, because cost controls is a big deal. You mentioned tariffs and things like that. We have the ability to know what we're going to need, right? We have an internal asset management team that's going to tell us. I mean, we drill down. I was having a meeting with our asset managers yesterday, and one of them was telling me he's got, for the blinds that we would have to order, he knows exactly how many blinds we need at each and every property, each quarter, broken down, like what are we going to need to order? And then, okay, if we know we're going to need X, we can buy it in bulk and get significant discounts associated with that. Not many operators are going to be doing things. And as small as those small little wins, they add up to big dollars, right? Because our valuations, like most real estate, is based on cap rates. So we know every dollar that we can add to NOI, what that does to drive value for our investors. And it's something that's consistent in mind. All right, how do we continue to drive NOI, right? I can't control what exit cap rates are. I can't control what interest rates are. I can control what's in between our four walls and a roof, right? We can control all those aspects. So control the controllables, right? And then out operate the guy next to me to where we're going to take whatever competitive advantage we can, being nimble, being able to order bulk, being able to control all the aspects of the deal, right? And where we can provide a product that provides best returns possible for our investors.
Yeah, super, super helpful, Sam, for you to break that down. Let's stay on the subject of investors, their mindset going into this current market and things of that nature. So there's a lot of fear, a lot of in the media, there's a lot of headlines that are making people very uncertain. What would you tell investors to do this quarter? Let's make it real time.
Sure.
If they've got money that they need to invest or want to invest, but they've kind of gotten sidetracked by some of these headlines.
Yeah, particularly with fear and things like that. You can quote some of the greats, right? I mean, immediately when you said that, I think of the Warren Buffett, be greedy when people are fearful and be fearful when people are greedy. I mean, it's literally one of his great lines. And I go back in time, right, and go, look, I remember buying assets at a time that felt just like this. And I do remember 2, 3, 4 years later going, oh my gosh, why didn't we buy everything at that time? Because this was the time it was really scary, but it's when the greatest opportunities were. And so it's scary, but it's also where we're seeing some amazing opportunities. And so this is the exact time that you, in my opinion, you do want to invest on the equity side in multifamily because of where we are in the cycle.
One of the things we haven't learned yet is really every multifamily operator has a specific way that they think about exit, right? Some are buy and hold forever. Some are just opportunistic. When the opportunity happens, they take advantage of it. And then in between, what's Lone Star's investment philosophy?
Yeah, I mean, I'm married to my wife. That's it. Everything's for sale, guys. I mean, I know I talk very differently than everybody up here in New York, but look, if we can make a lot of money on it for our investors, we're going to take that opportunity to do that. And so I'm a big believer in risk reward, right? And so for the appropriate amount of risk that you're taking, you should expect a certain amount of reward. And when there's an imbalance on that, either way, it needs to be addressed. So if there's a massive imbalance where your reward is far greater than the risk you're taking, you're probably going to look for an exit. And the other side of that, if there's a risk that's far greater than the reward you're taking, you need to put eyes on it and address it to get that back into balance. And so that's probably the simplest way I could say that.
We've asked Lone Star, you guys today, some pretty direct questions, but let's assume I'm an investor and I'm trying to just vet different deals, evaluate sponsors.
Sure.
What are like your favorite 3 questions that an LP investor should be asking to know if it's worth them investing there?
Sure. Number one would be, and it's really more of a strategy, does this align with my investment thesis? Right? That's literally the first question before even looking at the deal itself, right? Am I looking for multifamily deals in the state of Texas, right? Or the South or whatever it is? Because if you're looking for retail deals in Alabama, I'm not your guy. Like we don't even have to talk about the deal. We can communicate, have a good time, but we don't need to go into it. The second thing I would look at is the sponsor. Again, I'm not even talking about the deal, right? Are are we somebody you can invest with? Do we have a platform that speaks to you? Are we communicating? Are we transparent enough? Are you seeing what you need to see to know and feel comfortable to give us your money and know that it's going to be taken care of that way? I would then look at the structure of the deal. Like, how is it being structured? Are we feeing the junk out of this thing? Is it within market? Are we being appropriate for what we're charging? Are you getting the value for what's being presented? The last thing I would look at is the deal. That's literally the last thing. Those are I'd look at things well before I look at the deal. The deal itself, then, is the underwriting matching up with what you were underwriting? Are there variances? Are we answering what those variances are? Are we giving the answers to how our business plan is going to work from what you're seeing? I mean, that's really the process I would go through. Is you first got to make sure it aligns with your investment thesis, right? And then you want to know that the sponsor is somebody you want to be in business with for a long period of time, because it's a partnership, right? This isn't transactional. We plan on being in these deals for a while. Is the structure associated where everybody wins? And then does the deal work?
Sam, thank you so much for kind of, being such a good sport, letting us kind of, poke holes at the multifamily space, realize that, you're getting probably a lot of arrows shot your way from all the other industries and sectors, given how much success multifamily had for so many years, right? But obviously, to your point, it's being strategic, using and leaning on experience, and also taking advantage of when there are opportunities. And I've seen a few headlines that are pointing to we're in an opportunistic era in real estate, right? There's people getting scared, and for people who have experience, who have capital, who can take advantage of the opportunities, I think that's where wins will happen. For an audience listener who maybe is interested in what you're up to, where would you send them?
Yeah, I mean, I would say go to our website. We got a ton of content out there, but lscre.com, that's our Lone Star Capital Real Estate website. You can get a hold of me. You can get a hold of other teammates. You can see a lot of our team, things that we do, how we do it. You can see the portfolio, everything that you'd want to know right there on that website.
Excellent. Excellent. Well, Sam, thanks again for being willing to come on and share with us today. Wealth Without Wall Street Tribe. We pray that this has been valuable, that it has been equipping you to make the decisions to take the step in the right direction to get to your financial freedom that we're talking about every single day. Please, if you found value, like, share, subscribe, and help others who you may know get on their path to financial freedom. As always, have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.